Understanding parity price, a comprehensive overview. Parity price is a crucial financial concept representing the level at which two assets or securities are considered equal in value. This principle spans various markets, including fixed income, equities, commodities, and convertible bonds. Understanding parity price allows investors to make informed decisions by assessing the relative value between different investments. In this article, we will dive deeper into the intricacies of parity price, its different applications, and examples to illustrate its importance. Key takeaways. Definition: parity price indicates the price level where two or more assets have equal value. Applications: the concept is widely used across convertible bonds, commodities, currencies, and options trading. Financial implications: for convertible bonds, parity price determines whether it is financially advantageous to convert the bonds into shares of stock. What is parity price? The concept of parity price helps in determining the equivalent value of various financial instruments. For example, in the case of convertible bonds, it signifies the price at which it becomes more profitable for investors to convert their bonds into common stock. Furthermore, when comparing two currencies, if they are at parity, they hold the same value in terms of exchange. Example: consider a convertible bond priced at $1,200 that can be converted into 20 shares of stock. The parity price would be calculated as follows. Backslash text, parity price, equals frac, market price of convertible bond, conversion ratio, equals frac, 1220 equals 60. Thus, if the stock is priced above $60 per share, converting the bond would be financially beneficial for the investor. Purchasing power parity, PPP. A related concept is purchasing power parity, PPP, which compares the purchasing power between two countries by assessing the costs of a consistent basket of goods adjusted for exchange rates. It implies that identical products should cost the same in different countries when factoring in the currency exchange rates. Utilizing PPP. PPP is instrumental in economic studies and global investment, offering a more realistic measure of currency value. For instance, if a basket of goods costs $100 in the US and the same basket costs €90 in Europe, the PPP exchange rate should ideally adjust to reflect this discrepancy. Parity in commodities. For agricultural commodities, the parity price is defined concerning the purchasing power of said commodities relative to farmers' expenses like wages and interests. The Agricultural Adjustment Act of 1938 established a framework for parity pricing, aiming to stabilize farmers' incomes by guaranteeing that commodity prices reflect their production costs over a specified historical period. Parity in the forex markets. In the forex, foreign exchange, markets, parity signifies a 1:1 exchange rate between two currencies. For instance, if $1 equals €1, the currencies are considered to be trading at parity. This concept gained notable attention when, on July 12, 2022, the euro reached parity with the dollar for the first time in 20 years. Impact of currency parity. When currencies achieve parity, it has significant implications for trade, import costs, and economic policy for nations involved. Businesses operating internationally need to monitor these rates closely to hedge against exchange risk. Interest rate parity. Interest rate parity, IRP, is another financial principle that establishes a relationship between interest rates and currency exchange rates. It posits that returns from international investments should equalize when adjusted for exchange rate risks, leading to no arbitrage opportunities. Calculating IRP. The formula for IRP is essential for traders making decisions based on interest rate differentials between currencies. F_0 equals S_0 times left, frac, 1 plus I_C, 1 plus I_B right. Where F_0 equals forward rate. /S_0 equals spot rate. /I_C equals interest rate in country C. /I_B equals interest rate in country B. Parity in options trading. In options markets, the concept manifests in put-call parity, which describes the relationship between put and call options with the same underlying asset. This principle ensures fair pricing in options trading, denoting that if one option is overpriced, the counterpart must be underpriced to maintain equilibrium. Put-call parity formula. The put-call parity can be expressed using the following relationship. /C plus PV, X, equals P plus S. Where /C/ is the call price. /PV, X, is the present value of the strike price. /P/ is the put price. /S/ is the current market price of the underlying security. Risk parity. Risk parity diverges from traditional asset allocation strategies by evaluating risks based on asset classes. Unlike traditional methods that merely split investment across stocks, bonds, and cash, risk parity allocates capital more dynamically across various risk levels, aiming to achieve equal risk contribution from different asset classes. Covered versus uncovered interest rate parity. The distinction between covered and uncovered interest rate parity is vital for investors. Covered interest rate parity considers hedging against foreign exchange risk through forward contracts, while uncovered interest rate parity theorizes the relationship between interest rates and exchange rates without these hedges. Percent of parity. Percent of parity quantifies the deviation between two prices or rates, expressing them in percentage terms where perfect parity equals 100%. For example, a 90% parity indicates a 10% difference from equality. Conclusion. In summary, parity price is an essential concept in the financial realm, denoting equality and providing a framework for understanding various market dynamics. From convertible bonds to forex trading, recognizing and applying the principle of parity allows investors to capitalize on arbitrage and investment decisions. As financial markets evolve, mastering concepts like parity will remain pivotal for effective trading strategies and risk management.